We are very lucky today to have Evan McDonough from Family Mortgage on with us to talk a little bit about the home buying process in Florida. Frankly, Evan has helped me buy my home. So that's why he's here. We've referred him to other clients, and he's a very capable individual in terms of handling mortgages. So, Evan, without any further ado, uh, talk to me a little bit about when moving to Florida. What are the questions when coming to Florida in terms of buying a home? What are the questions that people should be asking?
Yeah.
Correct.
So thanks for having me. Really appreciate you giving me the opportunity to share some of our knowledge, especially being born and raised here in South Florida. I feel like I have a doctorate degree in the area plus financing wise. And so when I speak with a client, first off, is determining number one, because it's going to steer our conversation. Are we buying a primary residence, a new primary residence, or a vacation home, second home, investment property? Um, so more often than not, believe it or not, it's a primary residence. And so when setting up for a primary residence purchase, whether it be here or just moving any out of state scenario, is we want to know about income. Income's always the biggest thing, right? When we talked for the first time, it was like, hey, Evan, I have this situation. Here's what's going on. How do we structure income? So that's the first thing. We get a lot of clients that are relocating here and they keep their current job, or they could be taking a new job. And then, of course, we have retired clients. So getting into the income first is really going to steer our conversation into which loan product we're going to go towards, how easy of a process it is, the timing of everything. So income is always the first. Second is an area, because that kind of lets us know, um, you know, how hard it's going to be to get under contract, or a little bit easier because every pocket is a little different in Florida. So getting a little bit more into the goals right off the bat is what we want to talk to our clients about.
Got it. Um, Besides a really high quality mortgage person like yourself, what other professionals should a potential buyer have?
Well, of course, I always like when when clients are talking to financial advisors. Number one is it's a second set of ears to help bring things together, especially for complex situations or retired clients, asset-based clients, because then we can work together to find the best plan mortgage product. Um, CPAs, some you hear CPAs, some clients are very ingrained with their CPAs, and they're great to work with, and some just do tax returns. So you have a varying thing there. The lender, I think, is where the biggest piece of the puzzle is if you're getting financing, or if you are thinking about paying cash and just want to bounce the ideas off of us, because we're gonna be able to lay out the financial piece of things. Your real estate agent, of course, uh, just right behind everyone, because a lot of people go to the agent first, but really we need to know the numbers first, whether it be between us or your financial advisor. Insurance agent is huge here in the state of Florida. We can get it more into that here in our conversation. Those are the main players, I would say. Attorney to a So some states are very attorney driven transactions. In Florida, not so much. Some clients have attorneys to review everything, and some clients don't. So it's, I've never tell someone not to bring their attorney into this, but it is many transactions close in the state of Florida without attorneys.
Got it. See, that's one of the things, of course, Evan, that those of us who are coming from the Northeast are very ingrained to have a real estate attorney, right, present at any kind of real estate transaction. So that's what you're saying is basically it's really up to them, but it's not required for the closing, in effect.
Absolutely. Yep.
That's great. So you touched on this a little bit. Talk about, okay, well, the finances, as we always know, are very important. But what's the true cost of home ownership in Florida? What would you say are the things that people should really be paying attention to?
So I hear that Florida's unique when I talk to out of state clients. And there are some things that we need to talk about, but when you're talking about financing, most financing applies to the whole country. And I have a lot of clients say, well, that just sounds different to Florida or whatever, or something like that. But a conventional loan, meaning Fannie Mae or Freddie Mac backed and underwritten loan applies from here to New York to California to Texas and all around the country, right? So um, how lenders implement guidelines and what lenders put clients through can vary, and that's usually where you see the differences. But what's really sticks out as far as differences in Florida that I hear from clients is number one, property taxes. Property taxes, for instance, Palm Beach County, I use about 1.7% of the purchase price to guess what taxes will be next year. If you go to Martin County, which is one county north, I use 1.4%. If you go a little bit further north, there's St. Lucie County, that's back to 1.75%. And if you go north from that, it goes down to the 1.2 to 1.4 range. If you go down to Miami, you're more in the 1.7% range. That can be a huge difference compared to different areas of the country. So that is the big, and when clients are looking online, the calculators typically are underestimating property taxes. So that's the number one thing when a client calls me that they're usually like, holy moly, property taxes. And that's a legit thing. Number two, insurance. Insurance is very unique to Florida because we have a hazard policy, which most of the country has hazard policy, protects you throughout the year. Um, but then we also have a wind policy. So that protects you during hurricanes. Yes, in Florida, we have hurricanes. It's for a number of months every year. It's the price to pay to live in paradise. So we protect our homes. And so within having that, your home can have varying traits. You could have a CVS home. You could have a frame home. You could have a mixture. You could have a roof that's 10 years old. You could have a brand new roof or a 30-year-old roof. At some point, roofs are one of the biggest contributing factors to insurance policies. So just putting that in perspective, if someone buys a $600,000 single family home in our house, in our area, that policy, my guess as a plus minus would be $350 a month for insurance. If that roof is old, let's say they bought a roof and home, it's still okay to roof, but it's 25 years old, that policy might be $600 a month. But if they go buy new construction, that same policy could be $125 a month. So insurance, again, comparing to other parts of the country, is a first or second biggest difference when you come to the state of Florida. The last thing I think I'll mention, and you may have some other things you want me to address, is flood insurance. So a lot of clients get worried about flood. You could literally live on the water here in Florida and not need flood insurance by a mandatory flood zone because all of Florida's in some degree of flood zones. It's just a matter of, are you in a mandatory flood insurance if you have a mortgage? So very few, I would say out of, let's say 20 clients that close on a purchase, one or two, so 10% might be in a flood zone. And again, I've closed homes right on the intercoastal, no flood insurance needed. And I've closed a home, 5 miles inland. And because it's low laying, we needed flood insurance.
Got it. Now, would the cost of insurance, right? I think is a cost that a lot of people underestimate when they come here. Would you agree with that?
100%.
Okay.
They may
Also,
be ready for it, I would say, Ken, but then when they start to hear the numbers, like, oh, wow,
right.
I pay less than $1,000 a year. My home is worth $1 million. Well, that's just not going to happen here.
Got it. Got it. Does it vary the cost of ownership depending on the structure, whether it's a single family home, a home in a condo community, a golf course community, a high rise? Does that vary, Evan? And what else regarding those should people be aware of?
Yeah. So it brings up a good point. Is there, let's say there's three main classes of buying here, and that is a condo, a townhome villa, or a single family property. And so if you buy a single family home, freestanding, not in a homeowners association or country club, and you take that home and put it in a country club, that doesn't mean insurance is going to be any different. So it's more about the structure of that single family home. So a single family home in theory could have a little higher insurance than a townhome. Um, then a condo is a completely different ballgame. A condo where you're going to have an insurance policy from the condo association that will rebuild the structure, right? Which is one of the biggest costs to rebuild a structure. Excuse me. You're still going to need to do the insure the drywall in. So if you have a total loss, you would need to put your flooring down, your cabinets, your all the features in your home. So even though you're buying a condo, you still need to have insurance to rebuild it. A lot of people that pay cash don't get that interior policy. So they're technically risking if they have a total loss or even a minor loss that they're going to wind up rebuilding the interior of their condo.
God, that's really helpful. Just digressing a little bit, talking about property taxes, talk about the process of homesteading.
Okay. So homestead is another, honestly, I haven't explored other states enough to know if they have something similar, but homestead means that when you buy a primary residence, so keep in mind, second home, vacation homes don't apply, investment properties don't apply. Primary residence, you file homestead and you lock in the value of your home or your purchase price the year you buy. So if you buy a home today for $1 million and you homestead, which will go into effect January 1st, the year after you buy. So right now, you would buy, let's say today, it doesn't go into effect January 1st. All right. That locks it in. So every year thereafter, it doesn't go up or down more than 3%. And it also gives you a $50,000 reduction to your assessed value. Now, the assessed value is the part that basically means we can't calculate an exact number of what your taxes will be in the future. That's why I gave those ranges.
Sure.
And that's because it takes your purchase price plus the surrounding homes, condos, townhome values. So they do an assessment and then they come up with your final number. So to the good and bad, if you have a client that's buying $1 million property and they're like, let's back out costs, and we do furniture and they get creative and they have a factor of 900,000. Yeah, that will help to some extent, but the assessor's office is still going to do their evaluation and they're going to value the home based on the true value of the assessment. And then the $50,000 homestead exemption comes off of that.
Great.
So when you go buy a home, if you bought a home right now, and someone bought that in say 2000, it's 26 years later, they homesteaded. Maybe they bought it for 300,000 and today it's worth $1.3 million. Well, they're paying taxes based on a $400,000 or $500,000 home. Someone goes and buys it. It's going from $5,000 a year to $17,000 a year. That's why you have to use an estimate of the future taxes because it's so skewed based on the homestead exemption part of our property tax bill.
Got it. That's really helpful to know. Thank you for that. Talk a little bit about when you're talking to people for the first time, they're really not experienced about Florida, living here. Do you ever recommend, well, maybe you should rent for a year before you buy? What's your kind of feeling about renting versus buying timing?
I mean, I could totally be biased, right? Because I'm
Sure.
such a strong believer in home ownership that if it were me, I'd have a hard time renting ever again. And I haven't since I was 20 years old, bought my first townhome, right? So I've
Right.
owned forever. And so I think it goes down to how much do they know about the area? How settled in? Um, do they have a family? Do they have kids that need to go to school? But has anyone called in and said, "Hey, I want to buy a home. I'm ready to buy." And I'm like, "I think you should rent." No.
No.
Um, but have clients called in and we've pre-approved them. They're like, you know what? We got down there. We finally looked. We're a little torn. I think we're going to rent for 6 months or a year because we just want to make sure the school district is where we want our kids to be. We want to make sure that the area we're moving to is the life we want to live. Um,
Sure.
100%. 100%. Can you blame anyone? Absolutely not.
Yeah.
But in the Florida market, with the exception of the '08 crash, a little bit of pullback from the peaks of 2023. There's been very few times where if you didn't get into the market, you really benefited over 5 years in the Florida market.
Got it. What what are some of the regrets that you've heard? Have you heard any regrets from people who've bought a home 12 to 24 months after they've done the transaction? Have you heard anything about that? And any learnings?
Well, I will preface it with we try to stay in contact with our clients, but not everyone calls and tells me, what's going on with the hundreds and thousands of families we've helped.
Right.
What I would think has happened is someone moves here, they get relocated, they got to move after 12 months, and now they're losing money. Even if the market went up 3 or 5%, you got to pay costs to get out of a home, right? So you could have some negative effect from that. That same story as far as someone moves to, let's say Abacoa here, where my office is at. It's where Roger Dean Stadium is at for the St. Louis and Marlins spring training.
Sure.
There's a lot of families here. It's a mixture of families, retired clients, and but someone could get here and be like, this is terrible during spring training. There's a lot of kids running around and we want something quieter. Or they could get here and be like, this isn't enough. I want to be downtown West Palm Beach. And so that moving to the state and not understanding the areas of the pocket, I think probably would be one of the biggest, regrets.
Got it. Got it.
That
Because
in school, sorry about that. Schools. Yeah.
Right.
You think you're going to a good school, you get there and you realize, oh, what? I don't like this school. And now you're in private school or something
Right.
like that.
Which is another added extra cost for sure.
Correct.
Right.
Absolutely.
So let's talk about obtaining financing in Florida, right? To buy a home, because a lot of people, when they come to Florida, they want to have a mortgage. Some people want to pay cash. Tell me about, in your mind, the pros and cons of each. And then also, let's talk a little bit about, we can talk about after that, talk about how you've helped my clients who were retired and didn't think they could qualify for a mortgage, get a mortgage, and a substantial mortgage at that. So,
Sure.
Yeah.
So I think the pool of buyers that need a mortgage, right? So that's need a mortgage, just should think about leveraging their money within the mortgage. So a lot of clients call and say, I got to do 20% because I don't want private mortgage insurance. And just thinking about it makes sense, an extra cost. But mortgage insurance rates are so low right now because the foreclosure rate has been so low for so long. The premium that you can leverage your money by doing 10% down, let's say instead of 20 and on 700,000, that's 70 grand in the bank to only pay, if you have good credit scores, maybe $115 more a month. In my mind, I'm like 70 grand in the bank, $115 a month. That's a no brainer.
Sure.
So that is one pool client, something to think about is make sure to look at leveraging your money. And that's where we can get the numbers and you, of course, can review with them and say, here's what we'll do with it. And that's why it's nice to have financial advisors involved. Then you have the mixture, if I'm following the question, right, is now we have, should I get a mortgage or pay cash? Or should I leverage more of my money on a mortgage and keep more in the bank? And so I think that goes down to philosophies of who the client is and also their financial advisor. For me, my philosophy is if I can outperform my debt in the market or in my investments at a certain number, then I'm going to leverage my money and make money because of the simple concept of compounding interest, right? And a lot of people miss
Yep.
out on that compounding interest. And I have seen it work in my life for so many years that I will tell clients, this is my personal philosophy. This is, you review in your family with your investment team. But if rates are at 6% for simplicity's sake, and your investor has been averaging 9 to 11%, right? And you're okay with, and this is all prefaced with, you're okay with the monthly debt, then why not go make your money in the markets and keep your money growing? Especially if you're a young family and you're building wealth. I get a lot of questions of, hey, what if I pay an extra payment a month or a year or whatever? And I say, are you maxing out your 401k? And they're like, no. Well, 401k, you get a tax deduction the year that you put the money in. And a lot of companies match between 2, and I just had a client matched at 8%. So on 17.5, she might get a benefit of over 50% on her money that year. So using that kind of illustration and then growing it from there, depending on the client, is what I look at. So when rates were 7 to 8%, which was only, not too long ago, and they've come down, but then I start to question, is it worth it all? Is it worth it to maybe
Sure.
gain 1 or 2% and have the risk of having a down market and going negative? Then I could understand the cash buyer saying, I'm just going to pay cash and I'm going to wait to see what happens, and I'll pull the money out.
Right. I mean, I think, and that's the way the philosophy at Van Leeuwen and Company is that at 6% here, we clearly believe that having a mortgage is the way to go, because over long periods of time, as per your point, you can compound your asset, even if it's, the S&P does a little bit more than average of 9% a year. So that's clearly 3% more. But also what it is, which is super important, especially if you get a fixed rate mortgage, right? Just due to inflationary pressure, inflationary costs, the true cost of that mortgage declines every year because of inflation. So that's why another positive why you should get a mortgage, because of that inflation cost and compounding the money. Again, but it's all qualified. Like, some people are very opposed to debt. Okay. Got that. Understand. But this is good debt. This isn't credit card debt. This is a good debt to have. And of course, they have have to have the cash flow to make the payments, right? So,
I think that's a really under talked about point, is the inflationary. So you're locking in that $300,000 in debt at today's price and paying it down on the future cash flow of the inflation value. Is that what you're basically
yeah,
saying?
basically, because if you think about it this way, right? Not that people hold their homes necessarily for 18 years, but if you think about uh, a home and you're going to own it for 18 years, and let's assume inflation is 4%. So that old rule of 72, but now we use it in reverse, right? Basically is that debt was worth 300. Now, based on that inflation factor, it's really only 150 in today's real money. So that's how you've worked both angles for your betterment. And
Yeah.
that's why you see people, you have to be judicious with using debt. Yeah, we always know that. And again, that's a personal issue. But again, that's something to think about, especially in a lot of cases today. We have clients with portfolios that have capital gains in them still, even after this little downdraft here this month. So what happens is, they want to buy a home for cash. They have to liquidate assets in their portfolio, which causes capital gains. So they're paying an extra 20% on that money that they're generating. So that's why you have to think about it, in terms of the overall. So I think that's why, with a good mortgage person. And like you said, whether a financial advisor or a CPA or someone to kind of guide you, it's helpful in that regard.
Yeah. Yeah.
Evan, talk a little bit about, because this is where you've really been very helpful to a number of our clients, people who have assets, but not necessarily income in getting a mortgage. Talk about that, because that's a real must, in my opinion, a misunderstood thing that you do for people. Talk about
Yeah.
that, please.
So it's actually one of my favorite openings to a conversation is a client calls in and says, "Hey, I'd love to get a mortgage. I'm retired. I don't have the income to qualify." And usually that call can go one of two ways. One is they're going to go towards they do have assets, or every so often you do get the client that it's not going to work. They don't have a wealth portfolio. But more often than not, we're referred a client that is on Social Security and maybe a pension. And then because they set up things correctly with their financial planner, they don't have documentable income on their tax return because they're drawing on brokerage accounts that aren't taxed. They haven't even touched their retirement accounts. So it's number one, I like it because now we can be a shining light to figuring out a solution. And number two is a lot of times these asset-based loans or retired clients, it's easy paperwork. It's easier, let's say. So a client calls in, we talk about, again, Social Security, pensions, fixed draws that they already have, annuities. And then I ask the question of, okay, well, do you have a retirement portfolio? So that's 401k, IRAs, those type of product accounts. Yes. Okay. Do you have a round number in those? So they tell me the round number. Okay. Now let's set that aside. Do you have money in brokerage accounts? And what's that round number? Because what I'm doing is I'm trying to figure out, one, how do we get them qualified? And two, what's the easiest way to home plate? Because there are a number of asset-based products available to all lenders. It's just a matter of the lender knows the guidelines well enough to implement them. So believe it or not, Fannie Mae and Freddie Mac have a guideline that you can take. Let's just focus on Freddie Mac first. You can take someone that's 62 or older and take all of their accounts, retirement, cash accounts, brokerage accounts, 100% of the value divided by 240. So 240 months. And that's the income that you get to use. So that in itself, 240 months is a lot to hit, right? So someone has to have quite a bit of money to just qualify based on that. But it helps when they have Social Security and pensions. Fannie Mae is a little more restrictive. They want to do it by the loan term. So if you're getting a 30-year loan, it's 360 months. If you're getting a 15-year loan, it's 180 months. But there's a calculation. So then outside of that, if that doesn't work for the client, there are what's called asset depletion loans. Actually, let's take a step that for a second. That's the other easy way for a regular product is if someone has a retirement account, they can set up a monthly recurring draw because they have access to the money, and they can set it up and we document it at least one time before closing. And that's what we use for our income. It has to be able to continue for 36 months. So the calculation is easy. Whatever the number is in the portfolio of a retirement account divided by 36, that's your max monthly income. So a lot of clients will do that, but you do have to get it set up. You got to make sure your financial advisor's on board. You got to make sure you have the assets to send you the money. So there's a few extra steps, but a lot of clients use that. Then you have the asset-based programs where, remember, Freddie Mac and Fannie Mae want 240 to 360 months. Some will allow for 84 months division, or some will allow for 120 months. So that will give you more income. Those would be portfolio products, meaning that they're not going to get sold on Wall Street. They're going to be portfolioed on our books, so they're investors' books. Then you have Asset Qualifier, which is a cool program, which at simplicity's sake, let's say that you have $1 million you need $1 million for closing. You need a certain percentage documented for closing in addition to it. So you verify 1,500,000 on $1 million deal, and that deal qualifies. Now, I took you through the evolution of rates. The first thing I told you, Fannie Mae, Freddie Mac usually have the best rates and products. Then you have the asset depletion programs, which are in the middle. And then you have asset qualifiers are a little behind that. So every step, the rate and pricing gets a little bit higher. So it depends on the client, what they want to go through, what the best product is. And then we take that conversation and figure it out from there.
Got it. Well, that is super helpful because I think that's why clients or potential prospects should deal with a high quality mortgage person rather than just an 800 number or someone who's sitting at your local branch office of your bank, because these are very specialized and very unique, and you need a true professional to do that, I would say. Last question for you. Looking back in your career, you've been doing this for a while. Any mistakes that you've seen people make that they should avoid? And of course, mistake being a costly mistake.
Getting into a property where you have a short time frame on the hold, thinking you're going to make money. So if you look back at the Florida market, going back to 2000, again, there's been two moments that I can find. Well, there's one moment where if you bought a home, you weren't positive pretty quickly. And that is the '08, and it took until about 2012 for most pockets to start coming back. So that was 5 years.
Right.
Right. Then you have a little bit of a decline from the peaks. Now, the peak was in 22, 23, and it was astronomical, right? So was that a real market to pull back from? It kind of really just rebalanced, is more what I would say.
Right.
But if you go into it and you're like, hey, I'm only going to be here for 3 years and I want to make sure I make money, it may not happen, right? Because at very least, if you stay stagnant, you have to pay costs to get out of the property. So, but if you are going to be an investor and you're going to be in a home, whether, primary, second home investment for 5 to 10 years, there's very few times you haven't done well on the property in the past 20 plus years. So just know what you're getting into. Condos, we didn't talk a lot about it, but condos could be its own video.
Right.
Is just take into account, if you're buying a condo, what has the association done to make sure the building is up to the current guidelines for the state, and that it's in good condition, and they've done all of their reserve funding? Because I've had clients buy in 2023 and the HOA dues are $400 a month. And right now they're $1,100. So you've seen a $700 a month increase because of insurance and reserve funding in the matter of 2.5 years. So be careful of buying condos. Just do your due diligence.
Great. Well, Evan, thank you so much for your time today. I think that was super informative for all of our clients and hopefully yours. How can people get in touch with you directly if they'd like to?
Yeah, so we're the family mortgage team here in Jupiter, Florida. You can reach out to us at my office, our office line, 561-625-2660. And my email address, evan@familymortgage.com. So we can answer any questions on what we talked about or any new scenarios. We'd love to help.
Great. Well, thank you so much. And hopefully I found it super beneficial. And I hope everyone listening to this did. Hopefully everyone listening to this did as well. So thanks, Evan. We really appreciate it. Thanks for your time.